And welcome to another episode of the Capital Gains Tax Solutions Podcast, also streaming on expertcresecrets.com, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way for you to exit your highly appreciated cryptocurrency, public stock, private stock, real estate, a business. Eliminate the need for the 1031 exchange so you can create and preserve more wealth. Hey, I'm your host, Brett Swarts. In each episode, I am joined by some of the best wealth, financial, business, and real estate minds in the world where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited to have a repeat guest back on. He's one of the most intelligent and articulate gentlemen that I have the pleasure to be able to work with. In fact, he is the founder and CEO of Anfield Capital. He spent a number of years at PIMCO, one of the larger, well-known money management firms in the world. And he has an amazing background. And he's, in fact, a little bit more about David that you might have heard on the other episodes. He's actually a chartered financial analysis designation. He has an MBA with a concentration in finance from Paul Merge School of Business at the University of California, Irvine, and degrees in economics and political science from the University of California, Irvine. He's also taught finance and investment courses at the Paul Merge School, the Financial Times Knowledge Program in the UK, and CFA exam preparation courses sponsored by the CFA Society of Orange County, and so much more. Please welcome back to the show with me, David Young. Hey, David, how you doing?
Doing great, Brett. Good to be back. Hello, everyone.
I'm doing well. Yeah, excited to have you back. And for those who want to hear more of David's story, you can go back to the other episodes where we have, I think, at least 3 or 4 now, and this might be our 4th or 5th, and you can hear his entire story about overcoming false beliefs of the Deferred Sales Trust, his story about how to underwrite different risks and different things. But for this particular episode, we're diving straight in to our episode because we have a lot of content to cover today, and that's the U.S. economy and global market update. But before we go there, David needs to read a disclosure. This is part of the industry that he's in. So please bear with us as he reads this disclosure right now.
It's very exciting. I hope everyone's sitting down. Anfield Capital Management, LLC is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and no inference to the contrary should be made. This interview is for informational purposes only and does not constitute investment advice, an offer to sell, or a solicitation of an offer to buy any securities. While many of the thoughts expressed in the podcast are stated in a factual manner, the discussion reflects only Anfield Capital's beliefs about financial markets in which it invests portfolio assets at this time and may change at any time. The descriptions I make are in summary form, are incomplete, and do not include all the information necessary to evaluate any investment. Prospective investors are referred to our Form ADV Part 2A for a more detailed discussion of risk factors, which can be found on the SEC's Investment Advisor Public Disclosure website at advisorinfo.sec.gov or provided upon request. Thank you.
Fantastic. Thanks so much, David. And we're going to dive right into the U.S. economy and global market update. I think it's important, especially in these times, to get clarity on what's actually happening, right? There's a lot of news stories, a lot of headlines on the internet. And let's face it, sometimes it's hard to get through what's real and what's accurate. And so we're actually going to be sharing some slides today. And so if you're not watching this on YouTube, this is an encouragement to subscribe to the YouTube channel and to be able to see this on video if you're listening to it again on iTunes or Spotify. And but David will do his best to walk us through this. So David, let's maybe just kind of give the general take on the U.S. economic, economy and global market update. Kind of give us that, and then when you're ready to dive into slides, just say, "Hey, Brett, I'm ready to dive in."
Sure. So, truly unique, special, different time. I think that goes without saying. Been doing this for 35, 37 years, something like that. Formerly trained as an economist, kind of turned into a money manager. Over years, and I've never seen such a prolonged period of and such a massive amount of government stimulus in all its various forms. Low interest rates, that's a way of stimulating the economy. Obviously, other forms of outright, checks being mailed and other forms of stimuli are exactly that, right? This is meant to stimulate growth, and there's a whole lot of other things, somewhat more technical. I won't go into all of those, but long story short, And remember, it's not really just the COVID period. This is backdrop. It really, in some ways, there's an overhang from the great financial crisis back in, kind of 2007, 8, largely over by 2009. A lot of the liquidity and the measures that were being taken then are generally similar to the measures being undertaken now. Different time, different place, different reasons, somewhat different timing, different degree. But the point is, there's still, I would argue, an overhang, a 10-year plus now overhang of excess liquidity going all the way back to the, measures put in place during the great financial crisis. Interest rates never really got back up to where they were kind of, on average over longer periods of time. Again, a source of more stimulus in the economy. Fast forward, we're starting to really completely come out of that 10-year, difficult period. Whammo, right? COVID, only thing to do, cut interest rates, stimulate the economy, mail out checks, got to get this thing going. The engine cannot stop, or at least we had to restart it because we ourselves elected to kind of stop it, which is very, very unusual. In my experience in studying economic history for centuries and in my own personal experience, I'm not aware of a period when any government ever said, we will now shut down our economy, either, materially or some would argue kind of completely for a while. It's just never happened before. So we are in uncharted territory. And by the way, shutting down an economy, like shutting down a machine, isn't that hard. It's starting it back up that's hard, because you're not really quite sure what's going to happen. Could start up just fine, no problem. Could be very problematic, right? And so it's the restarting that was always going to be more challenging than the shutting down. And I think we're all experiencing that now. But long story short, 10 to 12 years of excess liquidity in the system. Fast forward, here we are now, more and more and more excess liquidity. That's the overall environment that the global and the U.S. economies are operating within. And it's got some pretty profound implications, at least for now. And if we look out 6, 12, maybe 18 months, it's very hard for us to see much past that. And I always try and find a vehicle to communicate this. And so the vehicle I chose not too long back in some public appearances was, saying it is the easiest forecast that I've ever done in my career, because it's really pretty obvious what's happening now, what's going to keep happening. I myself, therefore, in front of this audience, did not give the forecast. I basically talked them through making the forecast by asking questions, and then early on I told them, let me give you a little hint to our game we're playing. The answer to every question that we're going to ask is up. Up. Government spending up. As you can see here, if you're looking at the screen, by our red, yellow, green dials. We learned a long time ago, most people see things, it's fairly black and white. Colors certainly help. So we keep it really simple. Green dial up, good. If the dial is on the red down, bad. So government spending, what's the answer, everybody? Up. Consumer spending, up. Investment spending, up. Net exports, that's a different topic. We're exporting and importing. Normally, they're negative for the U.S., and the fact that they're not negative means that we're importing less than we usually do relative to our exports. So I don't want to go too down that path. But long story short, even on a net export basis, this is an up export basis. This is an up kind of number. And if we follow that theme through and go on to the next slide, which Brent is rolling over there, employment up, but slowing, right? Yellow to us means maybe like warming up or warming down, but in neither state. And so employment, the better part of the gains are behind us, but there'll still be a grind down in unemployment. That's good. Housing up. Talk to your friends, neighbors, go check out your house on Zillow, right? And even if we go then on Brent to the next slide, and then we'll stop and kind of summarize it all. A little bit different in interest rate world, because of course interest rates kind of are the opposite to what we think. Rates going down are good for bond prices and good for investors. Rates going up, bad for bond prices. But ultimately, I would argue not necessarily bad for investors, because of course, now you're earning a higher yield on your fixed income and debt and other of those forms of investments. But, the Fed's on hold. Interest rates keep wanting to push back up. They keep getting pushed back down, but they keep getting pushed back up. So that's a tug of war. Inflation clearly trying to go higher, higher, higher. Every now and again, we get information that, kind of cools it off a little bit, but there's clearly inflationary pressures bubbling. And against the backdrop or underlying all this is one of the more important things we look at, corporate earnings, which are, I mean, we're literally setting records. Some of that is off of abnormally low numbers of 6 and 12 and 18 months ago. We all know what was happening, 12 months ago. We were looking around wondering, is this ever going to end? Literally ever going to end. And so, so a lot of that is measurement and timing differences, but corporate earnings in corporate America is doing fantastic. They're on a very, very strong earnings run. And so if we go then into market forecast, and we'll pause here for a moment, this is a really good environment for everything but fixed income investors, where I would argue you can still hold some debt, some fixed income in your portfolios, probably should, depending on your situation. But we need to be thoughtful about how we're going to own that fixed income. So maybe to stop there and summarize, as I did with this large group of really very high net worth private investors a few weeks back, everything on my dashboard, all my gauges, they're green. They're up. And that's very a good sign for, risk assets, for real estate, for stocks, for other investable forms of assets. This period, in our opinion, just an opinion, will last for, another 6, 12 months, maybe a bit longer. There will be a reckoning out there. It can't go on forever. But for right now, it's really a very positive economic and market environment for investors.
Thank you so much, David. So much there. A couple that I want to dive into that I think would be potentially on our listeners' mind. So inflation seems to be the one that seems to be the most potentially devastating, right? But at the same time, seems like it's not. Sometimes it seems like it's going higher. It's, again, headlines, maybe not all the data. But can you just kind of give us what's actually happening with inflation and what your feel is in the next 6 to 12 months with that?
Yeah, so and there's been a lot of discussion about this. I'll try and do this briefly. It's a complex topic, but we look at inflation and we ask ourselves a few questions. Well, let me take a different tact, better tact. Some of the inflation we're seeing, which you've referred to as base effects. This is that measurement problem where if something normally costs $1, but it went down to 90 cents, and then it came back up to $1. If you measure dollar to dollar, no inflation. If you measure dollar to 90 cents, I'm backwards here. I got to remember that, right? Then, it went up by a little more than 10% actually. So the base effect is if you're measuring off of a base, which was abnormally inflated or abnormally high or abnormally low, it will make your percentage change look weird, right? We've all seen that, right? And so it's kind of like saying, today's, it's really hot today. Not compared to yesterday. It was 100 degrees yesterday. It's 101 today. Not very hot compared. But compared to a day in January when it was 50 degrees, 100 is really hot. So we look at the base effects. A lot of this is because COVID was such a dramatic, unusual. We talked about this very strange and shutting down of the government, the government shutting down the economies by choice, and I would agree it was the right thing to do. So strip out the base effects, which with the passage of time will wane. They will naturally roll off the back end of the data set, right? So I think the base effects, in my opinion, are, where are we now? August 10th. We've got another month or 2 or 3 of base effects. I'd like to see a solid year and a half from the very depths of COVID. So that would be one. Base effects still part of it, but rolling off. The second thing we look at, very important, is what I call transitory price effects. So these are basically a sudden spike in demand, maybe seasonal, maybe trying to get a hotel in the middle of summer, anywhere, not just this year. Well, they charge a little more, right? But it's transitory. Right? Structurally, the price of the hotel room hasn't really changed, right? But what's happened is because you're buying it at a peak time, there's a demand peak or a supply low. Go to the market and buy, look for fresh, blueberries in the middle of winter. And we're in California, we're spoiled. But if you're in another state, they might be more expensive, right? And so that would be a transitory kind of price effect. It tends to work itself out. Example there would be, one of our guys here who's didn't know he liked pineapple as much as he apparently does, was telling me a story about fresh pineapple. Apparently the price of fresh pineapple in the markets has spiked. And I says, oh my goodness, fresh pineapple prices have spiked. What are we going to do about that? And he was giving this as an example of inflation. I said, well, here's an idea. Don't buy any fresh pineapple. If the price of fresh pineapple went up, but nobody paid the price, did the price of fresh pineapple actually go up?
Did the tree actually fall in the forest?
I
Right.
don't know. There's one about the Pope too, but I probably shouldn't repeat that one, right? And then so there's that. And then the other one is, or buy canned pineapple, frozen pineapple. Substitute some other tropical fruit in place of pineapple in your tropical fruity drink, right? So you have make more pineapples. You can't really make more, but you can harvest more and ship more. They'll be a little smaller. They won't be quite as sweet, but will anybody really notice? And so there's all these effects that happen that makes it a transitory price change. Mm-hmm. Supply, demand, equilibrates, substitution effects are huge. So I'm just not going to buy it. Have you seen the price of these fresh pineapples? Forget it. I'll eat guava. So the transitory price effects are working their way through. The market will equilibrate. That'll take some more time. But now we get serious. So I'm not worried about the first kind base effect. I'm not worried about the second kind transitory inflationary price effects. I'm worried about the third kind, and we don't have enough information yet, which I know is an excruciating thing for an economist or market forecaster to say, but we really don't because it's been such a special period. And that is the one thing that makes price effects very sticky, that gets them down into the cake, bakes them into the economic cake, and they become structural, and that's labor. So supply-demand dislocation, government enters labor market, hires people to stay at home. That's really what happened, right? So now we have less available labor to fill the jobs. We reopen the economy. People go back out and say, oh, hey, come back to work. We're open again. I need you. They're like, no, I'm good right here. Thank you very much. Catching up on streaming old aliases or old episodes of Oprah or whatever. Right? And so until the government exits the labor market and all these companies and the local bakery and the big companies, Walmart and whomever else, don't have to compete with the government, that's going to be a problem. What I can't figure out is when the government exits the labor market. We can all debate whether or not they should be in it in the first place. That's as much political as it is and ideological as it is economic. But fine, they did the right thing in the beginning, I would argue. They entered the labor market, right? And when the government enters the labor market, what does it look like when they exit? When they exit the market? I don't know. You want to know why? The government has never entered the labor market at this scale, except for wartime. It's never happened. Literally never happened for this scale for this long. So I look at it and I say, would the government have prices structurally jumped up? Price of labor? Has the government affected the price structure of labor? If so, that will be a strong transmission mechanism and will be inflationary until we get another economic downturn. It goes like this. We reopen the local Home Depot where we need to hire people back and I don't know the numbers, and please don't get mad if I get the numbers wrong. It's $20 an hour, let's just say. And then the folks say, well, I'm not going to go back to work for 20. It's going to take 22, 23, 24. And then the big employers, Home Depot, Walmart, says, I could pay 22, 23, 24. I'm Walmart. I'm huge. Okay, come on back. Here's your dollars. Okay, fine. Problem. Now you replaced artificial demand for labor with, that's the government. They exited, right? The solution before they exit, raise up prices to compete on price. That's a problem. Government exits, no longer demand for the labor. I'm now Walmart paying that higher price for labor. It's going to be very hard for me to go say, hey, Brett, you know what? I know I'm paying you 22 bucks an hour and you're worth it and all that. So put that over there. But gee whiz, the market clearing price is really only 18, 19, 20 bucks an hour. So I'm going to lower your wage. That doesn't go over so very well. So wages are very sticky downward, right? They don't go down very easily. It's hard to get wages up, but once wages go up or start moving up, it's actually very hard. They're very sticky to move back down. So then you need an economic recession where you're laying people off and rehiring them at what would be a market clearing price to solve that whole demand, supply, and wage structure. And this is what we can't figure out. We can't figure out how much damage and distortion has been done to these kind of market clearing prices for labor. And so how much of that inflation is getting baked into the cake, right? And is going to be very hard to get back out. That's the part I don't know, but there is real inflation. It's not an alarming level. It's something to consider, but it is real. That was
Okay.
a little more than you had in mind there, but
No, I love it. It's actually the base effects, the transitionary price effects, and the labor, right? And I appreciate you breaking that down, because it's not, inflation is not a simple, math equation. It is multiple parts of this complexity that have to be taken into effect. That being said, I want to apply this knowledge to potentially what someone might do. So I want you to make the argument for owning real estate as a way to protect against inflation. So what would be the argument for that? And then let's take the reverse of that after that as well.
Sure. So as it relates to real estate, and as everyone knows or would know if they read our profile and all that, we're less about being real estate experts. Our clients hold a lot of real estate. We are here in Newport Beach, California. We're surrounded by real estate, literally, like everyone else. And so we see real estate more as an asset class and a set of cash flows, very large investment, leveraged, right? Probably the easiest available source of kind of natural leverage. It's just the way the asset is trades, the way it operates, the way it is financed, and so that's always kind of a wind at your back. And that leverage, by the way, is especially inexpensive right now. We've got, this is another phenomenon or byproduct of low interest rates. This is not a surprise to anyone. So I look at real estate and we ask ourselves a couple of things. Is it just a short-term, lots of demand because rates are low and there's not a lot of other good places to put the money, especially if you want some kind of an income stream, right? Equities pay decent dividends. Bonds normally would be a place where you would go, fixed income, to get some kind of an income stream. It's not there now because rates have been artificially pushed down so low. So where does that money pop up? It's got to go somewhere, remember. And a lot of that money pops up in real estate as a sensible alternative. I can get some upside market participation. I can avail myself of 4 to 5 times, depending on how you want to count it, leverage. I put down 20%, I borrow 80. That's 4 or 5 turns, depending on which kind of math you want to use. And I can get some income, and there's some good tax advantages. And so I think it's understandable to us why residential real estate, which I grew up thinking of as shelter, not so much a speculative or investment asset class, but still it is that. And non-residential real estate, it's a very attractive market because rates are low. Some of the other options are not as attractive, and the leverage and tax advantages included with the real estate. I think we could be, a couple of years into what might be a very long bull market in real estate.
Excellent. Now let's do the opposite, right? Now make the argument against, and in particular, I guess when I say real estate, I should be more particular. I should be investment cash flow producing real estate. I mean, there's different classes: multifamily, industrial, office, retail, right? Senior housing, assisted living, land development. So more so, I'm thinking of like multifamily, mobile home parks, cash flow. People need to live there. I mean, the essence of, they needed shelter, right? They'd be paying rent. And so more of those ones. What would be the argument against that to say, no, I think it might be better to put it here? That could be stocks, bonds, mutual funds. It could be, what would be the argument against it?
What would be the argument against it? The argument against it would be, that leverage can work both ways depending on how you go about financing that real estate. So beware over-reliance on variable, 3-year floating that turns into, 20-year fixed, or anything with floating or variable interest rates. It's great. Your money goes further. You buy more real estate. Your payments are lower, et cetera, et cetera. But I believe we are at a very unusual period. Rates are, as we think rates will go up from here, not right away, not immediately, don't worry, but the pressure, as we talked about before, right, the money's got to go somewhere. And clearly the pressure is upward movement in interest rates over time. And so if you have any type of a variable or other financing solution to your real estate, you might find your payments going up at probably exactly the worst time. So that's how you buy the real estate. Yeah. Beware, you're at an interest rate low, and we all know what that means. Anything where the rate could ratchet up. Number one. Number two. And of course, that could have a magnified price impact because of the leverage involved and the fact that you really only put down 20%, borrowed the rest. Yeah. Number one. Number two. Liquidity. Yeah, liquidity is always an issue. I am old enough to remember difficult real estate markets in the early 80s and at other points over time. And it's great on the up. Real estate cycles are long once they're in place. And I think we're in one now. They can run for 3, 4, 5, what am I saying? 4, 5, 6, 7, 8, 9 years. Long cycles typically, right? But when they break, as we saw in 2007, 8, they break hard. And it doesn't really matter. Even if you bought well, financed right, it doesn't matter. It's this wave-like behavior on an asset class basis. And I saw a lot of folks get hurt and sad stories. Probably over-levered, probably, had 3 or 4 different properties and were, borrowing on this to down payment on that, and just kind of built up this stack. And then when that stack goes against you, it's very painful. People get wiped out. So what I would say there to put all that in a can is, beware the illiquidity. There's an old adage, it works in a whole lot of areas. It works best in real estate. When people say, well, my house is worth X amount of dollars, I say, yes, on paper. But you know what your house is really worth? Whatever someone is willing to and able to pay for it at the time. That's what your house is really worth. And the trouble is, the only time you really figure that out, especially if it's a time of distress, that's a bad time to figure it out. And so liquidity is always a concern. The third thing I would think about would be, I think those are probably the 2 main things I would think about. And being aware that not all real estate is created equally. Equal. There are pockets of real estate that we could all look at it and go, that's kind of crazy. I live in one. It's kind of crazy. And there are other pockets and categories of real estate, as Brandon, as you described, that make more sense. So, I would just be wise about where you buy and what you pay.
Yeah, very well said. And I think that 2 things I really want to pull from that for our listeners is indeed the 07-08 crash, right? That's exactly why we started Capital Gains Tax Solutions, is because people were overpaying and didn't have enough liquidity, diversification, had too much debt. And part of that was because of the 1031 exchange, feeling kind of trapped by this big capital gains tax of 30 to 50% of depreciation recapture, and feeling like they had to 1031, and that caused them to overpay. And then the music stopped, and some of them lost half, some of them lost all, a lot of pain. And so the value of the Deferred Sales Trust is being able to sell high, pay off your debt, get that liquidity, get that diversification, and keep your powder dry in a safe harbor if and when a deal makes sense on its intrinsic value. By the way, we can learn more about that at capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. That being said, David, are you ready for the lightning round?
Yes, I'm ready.
It's a brand new lightning round because we've been through some of these similar ones. So I'm going to try to think of some new questions to throw at you. So if you had, and I know this is going to be tough, but as much as like a single answer or single sentence.
Okay.
If you had $1 million, okay, liquid right now in the bank, right, and you're considering your options right now, do you A, keep that money liquid right now? B, invest it into commercial real estate that you know, like, and trust in a good place. C, put it into the S&P 500, some of the biggest, companies in the world. Maybe you choose your top 10 that you really believe in, or top 50 you really believe in. It doesn't have to be 500. Or even just give me a percentage. Are you 33, 33, 33? Are you 50, 50? Are you 25, 75? Give me that breakdown.
So the normal answer would involve lots of background about, your condition, time horizon, liquidity, and all that kind of stuff.
Yep.
If you want my opinion, David Young only, not an investment recommendation. The two best places to be would be in, you said them, U.S. large cap equities. I think have a very nice road to run ahead. And depending on my situation, need for liquidity, and all that, I would certainly be considering an investment in some income producing form of real estate. Probably would avoid residential and look at some form of commercial.
Got it. Excellent. Great. And when you say residential, you mean like single family homes or like multifamily or both?
Probably avoid single family.
Right.
That market's so overheated. But if it was multifamily, I think that's more attractive to me than
yeah,
single
I'm with
family.
you. And then I also love industrial too, right? Where some of these large corporations like an Amazon or a Walmart or someone else is renting, right, and guaranteeing that rent. That can be very, very secure as well. Excellent. Second question would be maybe your favorite show or movie that you've seen recently that inspired you.
Oh gosh, recently. Well, let's see. My wife and I have taken to going back and watching some of these series that we were out of the country for many years working with PIMCO. I was living in Europe, so we missed this whole chunk of television time, and so we went back and we discovered, this is like nostalgic, right? The series Alias with goodness gracious, I can't remember her name. The What's in Your Wallet lady. Oh, come on, I can't think of her name.
But her, yes.
Yeah. Alias, Chuck, which was a funny old quirky series. So we've been nostalgic here as we go into the early parts of summer, because those two are fun. Watch them.
Excellent. If you have to pick, got it. If you had to pick one of the tax proposals that that would be the most devastating, stepped up basis, elimination of the 1031 exchange, or doubling the capital gains tax rate from 20 to 40, which one would you pick?
Ooh, the most devastating. I'll give you your answer a little bit backwards. If they do away with the 1031, there are alternatives. You just talked about one. In fact, I had that conversation the other day with an investor, and I said, no, it's not. This is not a 1031. There are alternatives. Mm-hmm. And in some cases, you could say that you wonder why people do 1031s. Right. So I'm not too worried about that. Yeah, tough. As a markets guy, liquid securities, stocks, bonds, investments, I think doubling a capital gains tax is the exact opposite. I personally think that they should do away with capital gains tax. They should be incenting people to invest. But stepped up basis is tough. The only problem there is I think that affects people more if they're in a reasonably high kind of economic bracket. Industry-wide or economy-wide, I would have, populace-wide, I'd have to say if they increase capital gains tax materially, that's a big problem for everybody.
Got it.
Yeah.
Very well said. David, it's been more than a pleasure having you back on the show. We're going to have you on again, too. Thank you so much for sharing about the U.S. economy and the global market update. We are all out of time. And for our listeners who want to get in touch with you, and remind, David Young helps financial advisors to basically, he serves financial advising communities, right? And teams and groups for their high net worth clients to help be a part of their kind of outer team or money management on another focused level. And tell David, would you remind our listeners where they could find you, especially if they're a financial advisor and want to reach out to you?
Yeah, absolutely. We do cater almost exclusively to financial intermediaries, right? Other licensed registrants. And it's AnfieldCapital.com. Brett's been kind enough to put the website on there, AnfieldCapital.com. We're not hard to find. And if you're a financial advisor in particular, interested in our services, views of the market, whatever the case might be, please do give us a call. Awesome. David, thanks for being on the show. Look forward to seeing you again soon. I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast, also streaming on Expert CRE Secrets podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy to replace the 1031 exchange, eliminate the need for it, defer capital gains taxes on just about any type of highly appreciated asset, including cryptocurrency,
primary homes, investment real estate, and businesses is the best way for you to exit and have a lot of freedom and flexibility to invest the wealth. I'm your host, Brett Swarts. Please rate, review, subscribe. I so appreciate everybody out there that's listening or watching this on YouTube. And we look forward to connecting with you real soon. If we can help you, go to capitalgainstaxsolutions.com, download our free ebook, learn more about the Deferred Sales Trust today. Thanks so much, everybody, for being in attendance watching this. And